those will be the big news stories and the headlines that we'll be tracking for you all evening on ET Now. But back to the Money Show, and today we decided to talk about hybrid funds. As the name suggests, hybrid funds are a combination of equity and debt. But it's not so simple. You have several kinds of hybrid funds as well. There's something called as hybrid equity funds and hybrid debt funds. Now the question is, we often tell you invest in equities for the long term and invest in debt funds when you have a medium term or a shorter term time horizon. What do you do whenever you have a hybrid fund in your hand? And secondly, what sort of an addition do they make in your overall portfolio, which may already be having a combination of equity mutual funds and debt mutual funds? So let's discuss that and more with Harshvardhan Roongta. He's joining us right now live on the Money Show, and also to answer all your questions and queries. Harsh, it's always a pleasure having you with us on TMS. And you know, today's topic of hybrid funds is something that we thought we'll pick up. The last 1 year have not been that bad for hybrid funds as it has been perhaps for a small cap or a mid cap fund due to a variety of reasons, and perhaps because of the constitution of some of these hybrid funds. I mean, you know, on one side you had some of these global funds and gilts funds especially do very well. So, you know, it took in the positives from that, but it also had to absorb some of the negatives from the small cap and equity parts of the portfolio as well. So first up, hybrid funds as an instrument. I mean, how do you like them? What are the advantages and disadvantages you see in them?
Well, Navina, if you're talking about hybrid funds, let's just understand what are hybrid funds. So as you rightly said, you know, there are a combination of different assets put together. So you will have equities in it, you will have debt, you will have equity derivatives, you could even have precious metals such as gold in it. So hybrid means a mixture of two different or three different asset classes put together. Now within the hybrid fund category also, there are different types as categorized by SEBI. So the first one, if I may talk about, I mean broadly let's talk about two or three of them. So the first one would be a conservative hybrid fund. So a conservative hybrid fund has a lesser portion of equities and a larger portion of debt. So you will see the equity portion may be restricted to about say 25% of the investments totally being made of the entire portfolio. So the portfolio consists of say about 1,000 crores, about 25%, about 250 crores will be equities and the rest will be debt. Now the other type of a hybrid fund is a balanced hybrid fund. Now in this, typically the ratio of equity and debt would be about 50-50% each. So you will have half of the portfolio being in equities, half into debt. Now there is another category which is most popular because of the preferred taxation rate that it enjoys, which is an aggressive hybrid fund. So the mandate as per the Income Tax Act is that a minimum investment of 65% needs to be made into equities and the rest into debt. Then it qualifies as an equity fund from taxation perspective. So an aggressive hybrid fund will have a minimum of 65% into equities and the rest in debt. So these are different kinds of combinations available in which an investor can pick and choose to invest based on their own risk profile. So somebody says, I don't want to take too much risk, I want to have equities in my portfolio, but I want to restrict them to say probably 15 or 20%. So then a conservative hybrid fund is available. If a person wants to take more risk and take a smaller portion of debt in it, so an aggressive hybrid fund is an option that an investor can choose to include into their portfolios. Now there are certain advantages of a hybrid fund. So one being, of course, that you have a combination of both put together. So you don't have to really buy two different schemes on your own. Suppose you wanted to invest 10,000 rupees and you wanted a combination of 70 and 30, 70% going into equities, 30 into debt. So what you would ideally do, 7,000 rupees you will invest into an equity fund. You will search what kind of equity fund you want and you will invest 7,000 there. 3,000 you will invest on your own into a debt fund. Instead, what you could do is just put the entire 10,000 rupees into an aggressive hybrid fund, which anyways has about 70% in equity and 30 in debt. So that headache of choosing two different schemes, managing two different schemes is taken away from your side. The other advantage of a hybrid fund is the automatic rebalancing. So what happens is, because there is a ratio assigned, which is that if I am investing 70% in equity and 30 in debt, which is the assigned allocation in an aggressive hybrid fund. Now, in case the equity markets start doing very well and the allocation, the equity portion, the valuation goes to about say 75 or 80%, and debt of course hasn't gone up that much, so the fund manager will automatically do a rebalancing. They will sell some bit of equity and buy into debt to maintain and bring down the ratio again to 70 and 30. So this kind of rebalancing of the portfolio was done automatically. An investor need not take the headache of doing it himself. So these are broadly the 2-3 different kind of advantages. These are the different kind of products in different categories available: conservative, balanced, or an aggressive, which an investor can definitely consider based on their own risk profiles.
Harsh, when we talk about equity and debt, it's plain and simple. That okay, you invest in equity mutual funds for the long haul, for wealth creation, minimum time horizon of 4, 5, 6 years, and then you have debt funds where you can, park your funds for the medium term, maybe 3 years, and liquid funds are of course hardly a month or 2 months or 3 months. How does hybrid funds fit into an investor's portfolio? Which investors should consider a hybrid fund?
So, well, if you're parking your money into debt with a view to redeem it probably in a month's time, 2 months, or even 1 or 2 years for that instance, then hybrid funds are not something that you can consider. Hybrid funds are your long-term asset allocation kind of product. So, if you're looking at an aggressive hybrid fund which has a minimum of 65% in equity, and in case you're looking to liquidate, you cannot only go out and say that I liquidate only the debt portion of it and let the equity be itself. So, you redeem, so you have the risk involved that is there with the equity investing. So, minimum time horizon of 5 years and above, because you have 65% and above in equities. If you have a shorter term requirement, but not as a liquidity needs. So, liquidity, by mean of liquidity, I mean as in you're parking your money temporarily and you're looking to redeem as and when required, then even a conservative hybrid fund is not for you. Conservative hybrid fund has up to 25% in equity, but again, you have to have a 3 to 4 months or 3 to 4 years time horizon in your mind, so that the equity portion has time to go through its entire cycles. You don't want an equity market to be doing well, unfavorably, and your valuations being low, and then you need the money and you withdraw. Those 75% into debt, the effect of 25% can be significant on your portfolio.
All right. Harsh, is there any differential tax treatment that these funds do offer?
Yes, as I said, the conservative equity hybrid fund has an equity allocation of only 25%. Yes. So it will be categorized as a debt fund from taxation perspective. So all your long-term capital gains start being accruing as start being eligible only after 3 years of holding into it, and the taxation will be 20% plus indexation post 3 years. If you redeem within 3 years, it's a short-term capital gains added into your income, and the entire income is going to be taxed as per your tax slab, the one that you fall into. The same is the case with a balanced hybrid fund, because the equity allocation is up to 50 or maximum 60%. And the income tax laws say that the minimum investment in equity should be 65% for it to qualify as an equity fund. So an aggressive hybrid fund qualifies for an equity fund, and the taxation rules that are that the short term is 15%, holding period 1 year, and 1 year and beyond it's 10%. Now that is applicable only to the aggressive hybrid fund with a minimum asset equity allocation of 65%.
Harsh, ordinarily, I mean, based on your experience, how have hybrid funds performed? If we have to look at the performance, especially versus equity funds, how would you say has the performance been?
So, well, if you watch the risk-reward ratio, I mean, the hybrid funds would fall in between a pure debt fund and a pure equity fund. So you will have a debt fund being very conservative in nature, giving you a return which is say probably 8% plus minus. Of course, different categories of debt will have different returns potentials. But a debt fund will be on the lower end of the band, wherein low risk, low returns. And equity on the other end will be high risk, high return. Now, because this is a combination of two, so the risk involved is going to be slightly more than debt, wherein it's going to be lesser than equity. So we're going to be in between what a debt fund does and what an equity fund does, and it's going to be in between. Now, if you talk about in terms of turbulent times, in terms of volatile situations, then of course hybrid funds give you that kind of solace in the minds of the investor, because they don't have to do this asset allocation themselves. The fund manager is anyways going to change the allocations based on the valuation. So if debt starts doing very well, they will sell debt and buy equity. And if equity does very well, equity is sold and debt is bought. So this, the concept of buy low and sell high is automatically applicable in a hybrid fund. So I think it fits right in between, a debt and an equity fund. And the returns, of course, again will be in between the two. Now, looking at what happened in the last 1-2 years, of course, pure equity funds in certain categories would have given a much higher return than what a hybrid would give. Similarly, if the markets fall, the hybrid funds are expected to fall lesser than what an equity fund would fall. I think it just falls in between the two bands for a person who's trying to be very, he wants to have an alpha generated on his investment, at the same time have some debt allocation so that there is a cushion available to his money.
I think the fact that these hybrid funds any which ways have to sell when the value of any one component, debt or equity, has gone up, that in turn validates that principle that you should buy when it's low and you should sell when it's high. So I think that is, I guess, an inherent strength that hybrid funds do carry with them. Okay, on that note, I'd like to kickstart our Ask the Money Show segment, where we open the phone line for all our viewers out there. So 24990300 is where you can call in right now, or you can always email us on themoneyshow@etnow.tv. First up, let me take on board our whole host of email queries that we have received. The very first question is coming in from Winston Suresh. He writes in to us saying, I wanted to know the difference between retail and direct investment in mutual funds. Why is there so much difference in NAV, and how do you get a direct mutual fund online? Okay, so starting from the very basics, when we do analyze the different returns as well among different mutual funds, you'll notice that a direct mutual fund does tend to have a little bit of a higher return compared to a non-direct or a regular mutual fund. So Harsh, if you could explain how that works.
So Mubina, very clearly, as per SEBI directives, all mutual funds have been asked to have two variants of every scheme. So one is a regular plan in which if an investor is putting his money, he actually is being directed through an advisor or a distributor agent, as the word may be, and the fund management, the total expense ratio of that scheme will be, say, probably 1.8%, for example. And out of that 1.8% expense ratio, a portion is being paid out to that distributor as commissions. And of course, the NAV is going to reflect this cost which is being recovered from the investor. So the NAV in that sense is after adjusting all the costs that have been incurred by the investor. Now, if you go to a direct plan, so a direct plan investor typically would be a person who is very comfortable and he's an educated investor. He believes that he can search and identify the good schemes, he can manage, he can track it, and he can do the entire process himself. Then there is no need for a distributor or an advisor in that case. So he goes and invests into a direct plan, wherein instead of now an expense ratio of 1.8%, his expense ratio would possibly come down to, say, 0.8% or 100 basis points or a 1%. Now this is in lieu of the fact that no commissions are being paid out to any distributor. The fund house is passing on that benefit to the investor. Now, because the NAV is a reflection after all these expenses in mind, since there is a lower expense in a direct plan, the NAV will definitely be higher. Now, because the NAV is higher, you should not really link it to saying that I'm buying something more expensive. That's not the idea. You have to look at the returns from where you invested in 1 year ago and what the NAV is today. So the gains are in percentage terms, nothing to do with the actual value of the NAV. So the idea is any cost that you save while investing, that is directly going to reflect into your returns. So that's the basic difference between regular plan and direct plans. NAV is just an indication. It does not mean anything otherwise other than just allocating units to you. So your actual returns in percentage terms is what you should look at. So a 10 rupee NAV or a 100 rupee NAV does not mean something at 10 rupee NAV is cheaper and so you should go for it. That is not really what you should be doing. Now, with regards to the other part of the question as to how does he go about investing. So first and foremost, do not only look to save money in terms of expense ratio if you're not confident of investing yourself. I mean, sometimes we do come across investors who try to get that extra return in the form of saving cost, but they don't know how to go about it. So you need guidance. If that is the case, you need to go for regular plans. If you can manage your money on your own, most certainly go ahead and invest into direct plans. In case now Winston wishes to invest into direct plans, well, one of the online platforms that he could consider, which is absolutely non-promoted by any corporate or entity themselves, is a MFU, the Mutual Fund Utility Platform. You can create an online account over there and you can start investing in any mutual funds through that. Or you can go to the fund house, whichever scheme that you want to invest into, and invest online through that platform itself. Before all this, you will have to, of course, make sure that you've done your CKYC. If that is done, you can do this investment online either through MFU or through the portal of the same fund house.
All right. Okay, Winston, I hope this has helped you in your journey to kickstart investing in mutual funds. A great product, and of course, if you do have the knowledge as to which funds you have to pick out, then a direct fund certainly would go a long way. Expenses are shorter, but again, don't compromise on the quality of what you're picking up just to save that small percentage of expenses. That as well is something Harsh has highlighted. Okay, very quickly, let's move on to Vijay, who is calling us right now on the show. He's from Chennai. Hi, Vijay. Good evening. Thank you for calling in. What's your question?
Good evening. This is Vijay from Chennai. So this is regarding some of the investment I have with HDFC AMC.
Okay.
So I have two mutual funds. One is like the HDFC Hybrid Equity Fund, and the second one is HDFC Small Cap Fund.
Okay.
So I'm holding units in these funds for more than 2 years.
Okay.
So, and in the last 2 years, the hybrid fund gave me a return of 5% on an annualized basis. And in case of a small cap fund, it is on a negative return.
Right.
Considering the present market situation.
Yes.
So, I would like to switch from the hybrid equity fund to the small cap fund. So, is it a right approach, first thing? So, my time horizon is minimum 3 years from now on.
Okay.
And the third one, suppose if I do the switch from the fund A to fund B, how about the capital gain taxation? Is it possible to get exemption for the capital gains?
Okay, HDFC hybrid, HDFC small cap, and like we've been saying, the hybrid funds have still done relatively better than small cap, and hence the hybrid fund is delivering a 5% return, whereas small cap is in negative. And now I think he's also applying the principle of sell high, buy low, so he wants to move from one fund to the other. So Harsh, is that a good idea? And also secondly, the taxation treatment.
Well, Vijay, you're clearly trying to see hybrid equity fund and a small cap are two different categories of funds. If I understand your intent is very clear that you're trying, because the small cap has not done well, you're trying to probably average your returns, your investment in that. And the easiest way is that if you've got into a hybrid equity fund, why not redeem out of it and buy something at a lower valuation in small cap? Well, theoretically speaking, this is not a good idea to do. This is not the way you should be investing. Hybrid equity funds have a different purpose altogether. A small cap fund has a different purpose altogether. A small cap fund is a pure equity fund, and it's a very highly volatile product. So ideally speaking, I would not even recommend having an investment in small cap at all. If you want to invest into small cap, go through a multi-cap approach so that a small cap, quality small cap companies can be included in a portfolio. Nevertheless, in case you wish to do that, you're most certainly allowed to do that, because you just have to give a switch request. It's in the same AMC, so you just have to give a switch request. From a taxation point of view, a hybrid equity fund, because you've been holding since more than 2 years now, it's qualified as an equity fund, and now it is long-term capital gains. So any gains that you make out of switching out, so switching out is a process wherein you're redeeming out of a hybrid equity fund and making a fresh investment into the small cap fund. So hybrid equity fund now will entail a long-term capital gains on you. The first 1 lakh across all investments that you do, the first 1 lakh of long-term capital gains is fully tax exempt in your hands. Over and above the 1 lakh, then there is a tax of 10% that you need to pay. The investment that you do in the small cap will be a fresh investment as on today's date, and tax that will be your holding, your purchase at date of acquisition. When you decide to sell, whether within 1 year or after 1 year, the long-term and short-term capital gain provisions will be applicable there.
All right, Vijay, I hope you've got your investment recommendation from Harsh. Very quickly, we're going to take on board our next query. It's Raj from Mysuru who's joining us on the phone line. Hi, Raj. Good evening. What's your question?
Good evening, madam. I would like to know about HDFC Balanced Advantage Fund. I have invested about 10 lakhs. Whether I can continue for whether is a good fund to continue?
Okay, what's the name of the fund again, sir?
HDFC Balanced Advantage.
Okay, and that's the only investment you have?
Yes, only one.
Okay, and you want to invest for the long term, right?
Yes.
Okay, 10 lakh rupees, a lump sum figure invested in HDFC hybrid. So firstly, Harsh, do you give that fund a thumbs up? And secondly, of course, if you could also just share in your advice on essentially diversification.
So when this fund hybrid, the HDFC Balance Advantage Fund has come into existence when HDFC Prudence, HDFC Growth, and after the recategorization process of SEBI was initiated. So this was created. It's a Balance Advantage Fund. So it is not a pure equity fund. It's not a pure debt fund. The allocation of equity and debt keeps varying based upon the valuations in the market. So it's a very good fund in case a person wants to invest a lump sum, and which this gentleman, Mr. Raj, has already done. So if he has a large amount of money invested into a balanced advantage fund, he can be reasonably sure that the investment in equities and debt are going to be variable, and it's going to depend on the valuations in the market. So very clearly, he can certainly stay invested in this fund and need not worry. Had he been in equity with a 10 lakh investment as lump sum, most certainly he'll be worried as to should I redeem now, should I book profits, or should I do all that bit. But in this case, he doesn't need to worry because the profits are automatically being booked by the fund house based on the valuation matrix. So my suggestion, Mr. Raj, just stay invested. Do not worry about it. From long-term perspective also, it is a good fund to be into.
Okay. All right. Thank you, Raj, for calling in. And with that, we'll curtains down on Ask the Money show. So thank you as well, Harsh, for patiently answering all our viewer queries. We'll take a very quick break right here on the Money show. But when we return, we are going to be talking about a new rule that the insurance regulator is mulling, and that is a higher self-declaration limit. It's certainly going to ease your life quite a bit. And to talk a bit more about this, we will be joined by Future Generali Insurance. So stay tuned for that conversation.